get a handle on what you should be buying at these levels in the market. Rajat Rajgarhia, Head of Research at Motilal Oswal, joins in to talk about that. Hi Rajat, good morning. Before I ask you about the markets itself, which everyone knows where it's going, what have you made of earnings season so far? I know the first half of earnings season generally tends to be better than expected, or rather not as bad as the second half. But this time around, have you been pleasantly surprised with some of the earnings performances? And if yes, which ones?
Hi, good morning. Well, yeah, most of the numbers till now have been quite okay. I think in the technology pack, you had some mixed numbers between Infosys and TCS. But after that, you had one Reliance, which at the pack level was better. You saw the stock reacting also positively to that. You had the whole private banking group, HDFC Bank numbers were okay. Axis Bank, we think yesterday the numbers were quite good. You had Asian Paints also, which reported numbers where the volume growth seems to be picking up. So there are numbers till now have mainly been isolated, but I would think that almost 2/3 of the numbers at least have been carrying this momentum positive from here. We have a very small sample of companies that have reported. Yeah, Idea was another one important number which kind of fueled up the entire telecom rally yesterday. So I think there are two set of companies. One where stocks have done very well, where they need to beat the estimate for them to carry the momentum. And second, where stocks have not been performing well, but some beat in the number like what Idea did can just fuel up the counters quite strongly.
All right. In that case, what would be your buy list from the earnings that have been declared so far?
Well, I think we are definitely seeing the private banks gearing up very well for the growth. Now, as we are expecting the GDP growth rates to bottom out at what we saw the last quarter numbers, they are already exiting this down cycle with very reasonably strong ROEs of 1.8 to 2% and ROEs of 18 to 22%. So if this is the bottom cycle ratios, I would wonder that when we start seeing the GDP growth from 4.5% moving up to 7% in the next 3 years, how much more improvement we can see in some of these numbers. So I think private banks as a pack is something which will continue to do well. In the technology pack, it basically right now will be more bottom-up focus. Tech Mahindra is something that we have continued to like for a long. TCS valuations have right now just reached more than what we thought would happen in the near term. So just be a little more cautious. But yes, telecom, I think what we saw in Idea, people are now extrapolating that to Bharti also on both traffic and RPM. That were to happen, you will see some more positive moves coming in the telecom stock in the very near term.
Okay, now if you have to buy more of these stocks, where would you make space for yourself? Would you not buy, say, consumer staples, ITC, HUL variety? Would you not buy pharma stocks? What would you avoid or even outright sell to make space for the list you're giving us?
Well, I think at this point of time, we are being very stock specific rather than sector specific. So we think that within the consumer pack, while the valuations for many of them look reasonably high, someone like an ITC would still be an outperformer. But within the consumer pack, you have to move more from consumer staples to the consumer discretionary, more which are focused on the urban consumption space. Similarly, in the technology pack, we think that given the valuation disparity that has happened between Infosys and TCS now, our weight on Infosys is now higher than that of TCS. On the other hand, if you look at private banks, we think in this upcycle, you have an Axis and an ICICI which are well poised to deliver an earnings growth acceleration. So we will be more overweight on them compared to some of the other private sector counterparts. So I think within the sector, we are just changing weight from one part of the space to another pack to fund the new buying that we want to do.
Okay, that's interesting. Rajat, from the auto ancillary space, we got two good quality companies coming out with diametrically opposite numbers. Exide, which was good, while SIAT, which actually disappointed. Would you buy either of these names post the earnings?
Look, SIAT we don't have a coverage, so I can't comment. But as far as Exide is concerned, I think it needs to be viewed in the context of the last 4 years of underperformance for the company. Last 4 years, we have seen a completely opposite performance between Exide and Amar Raja, where the market share gain for one has come strongly at the expense of another. At least this quarter, we have started seeing some positive trends coming from Exide, and typically investors want to lap up the first quarter of trend reversal in good quality companies after periods of underperformance. So Exide as a stock, after remaining neutral to negative for a while, definitely looks interesting for us right now. We think that considering that we are at the beginning of our up cycle in the domestic auto pack, some of these companies have well consolidated in their operations, and plus Exide can have specific triggers like insurance also, which can take the stock further higher from here. CED is something that we don't have on radar, so I won't be able to comment.
Okay, what about metals? There has been a huge rally, I mean, globally in the commodity metals as well as in the domestic stocks, Hindalco, Nalco, any of them. Your thoughts?
Well, somewhere the prices of most of these commodities, especially names like aluminium, zinc, etc., have bottomed out. If you look at last 2-3 years, they have largely bottomed at about this $1,700-$1,800, and they've started bouncing up from there. The marginal cost of production for aluminium in the world still makes this business quite unviable for many of the marginal producers. So the prices have to, with some gap, move up. Companies like Hindalco, etc., have also been doing well because I think they have now completed their entire capex cycle of the last 4 years. So the big period of investments is now paving way for period of commissioning and returns. You will start seeing cash flows, debt equity, and return ratios getting better. And in between this, if you get a positive commodity cycle, then these stocks can do further well from here. Hindalco as a stock, while has doubled from the lows that we saw sometime last year, it still remains an attractive considering the kind of asset buildup that they have done over the last 3 years.
The one shocker that came out yesterday, Rajat, was from Thermax. I mean, not the direction of the earnings, but the way in which the margins have decelerated this time, you know, more than 250 points down. Would you extrapolate this into, for the entire sector, in the fact that perhaps this quarter could be weak for a lot of these capital goods players?
Well, yeah, my analyst Satyam thinks that Thermax is not going to be an aberration in terms of earnings this quarter. You are going to see weak trends coming from most of the capital good companies. Also important to note here, Sonia, is that normally first quarter is one of the smallest quarter from the full year numbers point of view, and these companies are still trading out of an IIP growth which was 0 to 2% for the March quarter. So whatever improvement in sentiment, stock markets we are seeing, for the capital good companies, that will take at least 4 to 5 quarters for it to be reflected. Right now these companies are building their order book. So that is more important for us to see where are they moving ahead in the cycle. The reported P&L account for them will continue to look good. Thermax numbers were surely disappointing, and I think we will see more such numbers coming from other capital good companies. We have a call with Thermax today where we are organizing their earnings call. So we hope to get more clarity and guidance from them for the rest of the year.
Okay. Well, you spoke about consumer discretionaries rather than staples. What will you put in that list in terms of stocks? Will it be Titan? Will it be some of the auto stocks?
Well, the consumer discretionary basically will move from where once the sentiment starts turning better and the income growth level improves, what is it that the consumer is buying? And if you look, and that list is from small ticket item to the big ticket item. In the small ticket item, you can have items like Jubilant Foodwork, Titan, some of the other entertainment companies. And in the big ticket items, you can have companies like Maruti. You can have mortgages which are just being made attractive almost every month through some measure or other by either RBI or the central government. So this is one pack which I think is looking very exciting. Asian Paints is another consumer discretionary where if mortgages are going to revert back to a strong growth, then you will see paints also benefiting out of that. So I think this is the pack that I was referring to, where many of the small ticket to the big ticket, but which benefit because the urban consumer starts looking to spend more. are going to do very well.
You buying them already, or are you waiting to see an uptick in mortgages or government policy?
Sorry?
Are you already buying, what you said, mortgage companies and the consumer discretionaries, or you are waiting to see some uptick in consumer spends?
No, we are already buying, because if you look at our model portfolio that we had articulated in our June quarter end strategy report, that portfolio is quite well tilted towards the urban consumption items. And I think mortgage as a space, you know it very well, that mortgage as a space has continued to do well, very well over the last 5 years, 10 years, 15 years. The government policies just make the growth rates even more higher in the years to come, and companies will focus even more to pass on those benefits to the consumer, fueling the demand further.
Okay, I just had one follow-up question to your view on the IT sector, Rajat. We've seen some of these companies in the mid-cap IT space report disappointing numbers, so be it KPIT Technologies, be it Hexaware, where the margins fell a lot and the management said that the margins will continue to remain weak. Is this a space that you would be interested in, or would you stay away? And if you are interested, what would your stock recommendations be?
Well, I think at this point we would stay away from most of these mid-cap IT companies, because there are two things. First, the entire sector got benefited from the tailwind of the currency over the last 3 years. That tailwind is not going to be there for the sector anymore right now. The currency depreciation will be very moderate compared to the big that we saw last 3 years. So large cap companies will be able to manage it much better compared to the mid cap companies. And secondly, we have seen over the last 1 decade, Sonia, that in different phases of growth in the IT pack, you have different mid-cap companies which does well. Rarely does a company from the beginning of a cycle till the end of the cycle doing well. Tech Mahindra was one such company which about 15 months back in the mid-cap pack was looking quite attractive, but now they have also migrated to a large cap basket. I think it is when you have large cap companies like Infosys trading at 15 times, Tech Mahindra trading at 15 times forward, they make a lot more sense than to buy mid-caps at about 10, 11 times. The valuation arbitrage is not significant enough to take that added risk in the mid-cap pack right now.
An argument. Finally, Rajat, as a house, what are you working with in terms of earnings growth in FY15 and in FY16?
So FY15, we have an earnings growth of 14% at the Sensex level, and more importantly, this number has virtually remained unchanged over the last 12 months, and we have seen the first 6 months of the last 12 months being quite bad and the last 6 months of the last 12 months being quite good, but the estimates have largely remained unchanged. More importantly, every quarter I am seeing the earnings upgrade happening for FY16, and I was pleasantly surprised when I saw that in this quarter our bottom-up estimates are indicating a 20% growth in FY16. I just wanted to highlight one point here. Over a 10-year cycle, our earnings CAGR is always 15%, but we have 5 years of 8% and 5 years of 20%. We have lived through the last 6 years with an earnings CAGR of 8%, and in the first year of upcycle, if our analysts are estimating 20% growth, I think the next 3-4 years of earnings growth are going to look very exciting. So to be more specific, FY15 we have a growth of 14% and FY16 we have a growth of 20%.
Okay, aapke muh mein ghee shakar. Thanks, Rajat, for joining us and giving us your views. We hope that actually plays about.
Sridhar Shivrao,
he said the same thing.
Yeah, exactly, developed the same point, and he said it's not just 14 to 20%. He expects a doubling of earnings growth in the first year when GDP starts developing. So,
in fact, he said that 15% is actually being under-optimistic, is being conservative. So I guess that's the base perhaps that we're at right now. But thanks, Rajat, for that optimistic start to the morning, and you have a good day.